Welcome to this explainer. Look, today we're taking you from absolute zero to feeling completely confident in the stock market. And we're going to do it using relatable, everyday analogies because, let's face it, diving into investing completely blind, that is just a guaranteed recipe for financial disaster.
Think about it like this. If you jump on a bicycle without actually learning how to balance first, you're going to fall, right? It's exactly the same here. You wouldn't cook a massive, complex dinner without a recipe, so we absolutely must stop treating the stock market like some wild casino gamble based on random YouTube tips. You have to remember, the money is yours, the decision is yours, and ultimately, the loss is entirely yours. All right, here's our roadmap for today. We'll start with the smart investing mindset, take a quick trip to a wholesale vegetable market, meet the regulators and big players, set up our DMAT and trading accounts, and wrap up with the basic types of orders.
Section 1. The Smart Investing Mindset. Learn before you invest.
So, there are some pretty massive traps you absolutely have to avoid. The most common causes of total financial disaster include making decisions after getting hyped up by movies, following so-called hot tips from your relatives, blindly trusting random Telegram channels, or just panic reacting to the daily news. Relying on those things, it literally guarantees losses. Actual education is your only real protection here. Learning must always come before you invest a single rupee.
Moving right along to Section 2, the wholesale vegetable market, understanding shares.
Let's transform this intimidating stock market into something we all already get. Think of big companies, just like farmers. You know, farmers often need extra capital to grow more crops or buy better tractors, right? Well, companies need capital to expand too. And to raise that cash, they sell off tiny parts of their ownership to the public. So a share, or a stock, is simply that, a very small portion of ownership in a company. What's kind of fascinating here is the sheer simplicity of the scale. Imagine a company chops its total ownership up into 1,000 small parts. If you step up and buy 10 of those shares, you literally become the owner of 10 parts of that company. It is exactly like buying 10 kilos of potatoes from a wholesale market. Once you buy them, they belong to you. Okay, so where exactly do you go to buy these corporate potatoes? Well, you head over to the BSE, the Bombay Stock Exchange, or the NSE, the National Stock Exchange. These are massive physical mandis, or market platforms, where these companies come to sell their shares and where buyers, like us, go to purchase them. Now, if you want to check how the whole market is doing without obsessively tracking every single stock, you just look at an index. That's the Sensex for the BSE and the Nifty for the NSE. This acts exactly like a thermometer. Just as a thermometer checks your body's temperature, the index shows the overall health of the biggest companies. When those companies go up, the index rises, and you know the market is healthy.
Section 3. Regulators and big players. SEBI, FIIs, and DIIs.
Let's kick this off with the ultimate referee, SEBI, the Securities and Exchange Board of India. SEBI acts just like the RBI does for banks. It is the strict supervisor and watchdog of the entire stock market. Its whole job is to make sure that all the rules are followed, that zero fraud takes place, and most importantly, that your hard-earned money and your interests are heavily protected. Now, picture actual market trading as this massive, high-stakes cricket match. On one side, we've got the FIIs, foreign institutional investors. They're the foreign team, bringing in massive funds from places like the US or Europe. And on the other side, we have the DIIs, domestic institutional investors. That's our home team, made up of huge Indian institutions like LIC or various mutual funds. Both of these giant players heavily influence the match's final result with their immense buying and selling power.
Section 4. DMAT and Trading Accounts, your stock market toolkit.
Look, before you can buy a single thing and step onto the field yourself, you need a broker. A broker is simply a company that gives you the access you need to buy and sell shares, and they do it for a small fee called brokerage. Think of brokers like Zerodha or Upstocks as the friendly shopkeeper who actually executes your trades for that little fee. All right, these accounts are the absolute core of your toolkit. Your trading account is exactly like an everyday savings account. You use it actively to place your buy and sell orders. Your DMAT account, on the other hand, is your digital locker. You don't trade directly from it. Instead, once you buy shares, they are automatically moved and safely locked away in this electronic DMAT vault.
And that DMAT locker, it's securely opened and managed by either CDSL or NSDL. Think of these two as the massive digital banks of India whose sole job is holding your shares in digital form. They basically do the exact same job as each other, they're just managed by different organizations.
Section 5. Basic types of orders, taking action safely.
Consider this your ultimate cheat sheet for actually taking action in the market. A market order means you want to buy right now at whatever the current price is, say snapping up Reliance instantly at 2,500 rupees. A limit order means you're being patient. You only buy if the price drops to a very specific level, like waiting to grab HDFC only if it hits exactly 1,630 rupees. And finally, the stop loss. This is an automatic sell order designed specifically to save you from a massive loss. So if you bought at 500 rupees, setting your stop loss at 480 strictly limits your potential loss to just 20 rupees.
So the really crucial takeaway for your personal strategy is just this. Market orders are for speed. Limit orders are for discipline. And a stop loss, that is absolutely vital for your financial survival. It ensures you don't blow up your entire account in a sudden crash.
Because remember, true success in this market, it is absolutely not about luck, it is about learning first. So I'll leave you with this question to ponder. Will your next investment be a blind guess driven by fear and random group chat tips? Or are you ready to take control, respect the rules of the game, and make a truly informed decision? The choice is entirely yours.